So what exactly does rolling a covered call mean? Rolling simply means closing your current short call and opening a new one. You can roll to a different strike, a different expiration, or both. The goal is to adapt as the market moves and keep your position working for you. Why do we roll a covered call? There are four main reasons to roll: to capture more premium, to avoid assignment when the stock moves higher, to increase the upside if you're bullish and don't want to cap your stock gains too early, and finally, tax considerations. Sometimes if our covered call has gone in the money, we might not want those shares to be called away because that could trigger capital gains tax. So we might need to roll or adjust our covered call in that case. Let's look at our first example, which is rolling down to produce more income. So for example, if your stock has dropped, your covered call may have lost value. You can buy it back cheaply and sell a new call closer to the current stock price. A good rule of thumb is if your covered call that you've sold has lost 80% of its value, that's a good time to buy it back. Rolling down increases the premium collected and helps to offset any potential unrealized losses in the stock. The trade-off is you're giving up some upside if the stock rebounds. Another scenario you might come across is the stock has rallied and you want to roll your call option up. If the stock's rallied, your short call might be in the money. To regain upside, you can roll the call up to a higher strike. This will usually be a debit transaction. So the premium that you receive for selling the new call option at that higher strike is going to be lower than what it's going to cost you to buy back the initial covered call. But you can think of it as buying back some upside potential or giving yourself some more capital gain potential. The only way to do this move for a credit would be to roll up in price and out in time. So when expiration approaches, you can roll out to a later date. This lets you keep earning income from time decay while maintaining covered call protection. Rolling out also helps if you want to avoid assignment and continue with the strategy. The final example we're going to look at is rolling up and out. This is one of the most common adjustments. For example, if your stock rallies above your strike, you might close the current call and sell a later dated higher strike call. What we want to try and do is roll up, but also roll out in time in order to do it for less of a cost or even potentially generate a small credit. So rolling up and out pushes out your break-even price, keeps the income flowing, and gives you more upside potential.